you do see that we'll come to a period where, okay, that ratio gold silver price action will grow wider and then it'll grow lower, which is where I think we are right now. And then as the hyperinflation kicks into gear, it goes huge again. And when I pulled the chart, and you can see where they got the 15-1, it actually broke above the highest, according to the long-term trends, was 121-1. Now, when I checked it yesterday, it was at like 54 and change to 1. There is a support level on the bottom at 50. So what I'm looking for is it going to bounce off of that? Is it going to break through that? If it breaks through that then becomes the new resistance level on the top. And the next level of support that I see is at like 40-1.
The gold to silver ratio is approaching a decisive technical juncture that could signal the next primary phase of the precious metals bull market. Currently hovering near the mid-50s, the ratio is testing a critical support floor at 50. A confirmed break below this level would fundamentally alter the market structure, flipping previous support into resistance and clearing the way for the next key valuation zone at 40. This compression aligns with historical patterns observed during currency resets, where the spread between the metals narrows significantly before expanding again as hyperinflationary pressures accelerate. The analysis suggests we are currently in a phase where silver is poised to outperform, potentially driving the ratio back toward historical norms. Lynette Zang, chief market analyst, emphasizes the importance of these specific technical markers. She notes that while the ratio previously reached an extreme of 121-1, the current price action is focused on whether the 50 level will hold or fail. Zang warns that investors must monitor this zone closely, as a breakdown here would confirm a trend shift, signaling a move toward 40-1 and validating the thesis of a collapsing fiat system. This potential breakdown is not merely a technical anomaly, but a signal of a broader currency life cycle event. As the ratio compresses from its historical extreme of 121-1, it typically precedes a volatile inflationary phase where silver attempts to catch up to gold's monetary status. Investors are urged to watch the 40-1 target closely, as a breach of this secondary support level could remove remaining structural friction and accelerate the move toward a far more aggressive repricing of the white metal. Now, we present the clips from Lynette Zang's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Let's start, but it's all doable, so okay. We're good. And we'll start with the ratio, because obviously I just did a piece on it, and I know that people talk about that all the time, so I always want to address it and help people make educated choices.
Okay.
But when you're talking about swapping gold for silver, silver for gold, and swapping back and forth, what you're actually doing is talking about a trade. And for me, sound money is my foundation. So I don't want it to wobble back and forth trading it. But, in your process, what was the first thing that we started talking about? What you're trying to accomplish, right?
Yep, my goals.
Exactly. So it's really about the right tool for the job, because when you're looking at silver and gold in any form at all, there is a finite amount of it. And, we were saying earlier, there's gold and then there's gold, there's silver and then there's silver. So your goals, no matter any investment that you're doing, your goals must come first and drive whatever it is that you do. So personally, and also having done so many studies on what happens with gold and silver during hyperinflationary currency resets like we are in, you do see that we'll come to a period where, okay, that ratio gold silver price action will grow wider and then it'll grow lower, which is where I think we are right now. And then as the hyperinflation kicks into gear, it goes huge again. And when I pulled the chart, which anybody can do, it's free, longtermtrends.com, you can pull the gold silver ratio pretty easily, and you can see where they got the 15-1. And you can also see when that pattern shifted in 1913 or 14, where it went to a 20th of an ounce of gold. This is a $1 gold coin, to 1 ounce of silver, that 20-to-1 ratio. Okay. So, and you have different things for different functions, but you can see it go down, then you see it go up. It actually broke above the highest, according to the long-term trends, was 121 to 1.
Okay.
Now, when I checked it yesterday, it was at like 54 and change to 1. There is a support level on the bottom at 50. So what I'm looking for is it going to bounce off of that? Is it going to break through that? If it breaks through that then becomes the new resistance level on the top. And the next level of support that I see is at like 40 to 1. If it breaks through that, if I recall this accurately, I don't think I see any more resistance until we get down into those lower levels, maybe 20 to 1 or what have you. However, on the flip side of that, if it fails to break through that bottom support level, we have broken above the all-time high to go to that 121. So what I think is going to happen, which would be historically accurate, is we could test it. We could even go lower. But especially with inflation rearing its ugly head, again, in a very vocal way, means high noticeable price increases because of the inflation that they call growth. Okay. But it's really inflation, growth. most of it. I don't buy it for the ratio. And if you are heavyweight, if you go in and you say, okay, we did an assessment of what your day-to-day living looks like, and we have it broken out. Okay, so what do you want? You want silver for that function, or do you want gold, barterable gold for that function? In this case, we're talking about barterability, right? And if it's property taxes, you want gold. Mm-hmm. If it's buying a tank of gas, you want silver. So again, if you are sitting on a tremendous amount of silver, we also take a look at, you already paid the fees to buy that silver. Does it make sense to swap that out? It might not. It kind of depends. But you can pay your property taxes with silver. It's just going to take a lot more and a lot more space. But if you already have it, we're not about churning your account. This is about making sure that whatever it is that you do actually supports exactly what it is that you're trying to accomplish. And so I believe strongly that I don't really care what the ratio is, because I'm not going to trade my silver. I have enough silver for myself and both of my children for 10 years. I think that's enough, right? But if I were to actually weigh the number of ounces of silver to the number of ounces of gold, even in collectible form, I have way more gold. And the reason why I have way more gold is because of my personal goals, which is to take advantage of what's happening. I can't change it, right? I can't stop the rest of the erosion of the dollar. We need a big crisis. It needs to end. I'm trying to have a global impact on sound money by getting redeemable gold back in the system again. It's why I travel as much as I do talking about this, because there's 1% that's ruling us. If we can get 3% of the global population to really quiet revolution, just buy gold and silver, now we can have a voice in this next system. And if it's redeemable, and what that means, just like this, right? When we had these gold certificates, if I did not like what I saw my government doing, I could walk into the bank with this and pull the gold out of the financial system. This is why gold forces fiscal responsibility.
The gold-to-silver ratio is currently testing a pivotal support level at 50, with technical models suggesting that a breakdown here would flip this floor into resistance and clear the path toward 40 and eventually 20 to 1. While these compressed valuations present theoretical arbitrage opportunities, the analysis argues strictly against treating sound money as a speculative trade to be wobbled back and forth. Instead, the focus must remain on utility and selecting the right tool for the job, utilizing silver for daily transactional necessities like fuel and gold for preserving large-scale wealth or settling property taxes. In a hyperinflationary environment, the primary objective is not to churn accounts for short-term profit, but to secure a tangible standard of living. This strategy prioritizes physical possession over ratio gambling, ensuring that one's financial foundation remains stable, regardless of the volatility in paper markets. Financial commentary highlights that the ultimate significance of holding precious metals extends beyond personal gain to a quiet revolution of fiscal accountability. Experts argue that if just 3% of the global population were to reject fiat currency in favor of physical gold and silver, it would effectively strip the ruling elite of their ability to govern through unbridled debt creation. This return to redeemable assets is described as the only mechanism capable of permanently halting the erosion of the dollar. Unlike the current fiat system, where debt limits are illusory, a gold-based framework empowers individuals to physically withdraw their capital from the banking sector when governance fails, effectively vetoing inflationary policies and restoring financial sovereignty to the public. Let's get back to the interview.
Spot gold, which is just a lie anyway, but spot gold is frankly nearing 5,000. Remember, all of these had the same face value, $20. Now you tell me, is it because gold is worth that much more or that the dollar is worth that much less? And I will point out to you, one place, the financial system, one place, the financial system. This is not a conclusive list. 33 places, 33 entities use gold. And I just am in the middle of this work. So this is brand new work for me. So I haven't quite yet counted out. Silver, there's a little bit more.
Okay.
So when you're going, why does it fight inflation? Because it's above, both of these are above all governments and central banks' ability to inflate away because of the demand. I can't really call it a standard because it's only been around since 71, but the debt-based system died in 2007, but it became apparent to everybody in 2008. And global central banks had started accumulating gold, so they changed the trajectory of their leases and purchases and sales, all of that, in 2005. Isn't that interesting? And so today, what are we seeing? We're seeing the global central banks buy more gold than they ever have since they started tracking it back in the 50s. And so when you stop to think about what happened in 2008, it was the monetary system. And when you look at this new socialist movement, what are they going to do? They're going to cap rents. You know what garbage that really is? That means nothing. That just hurts the owners of whoever has that building. And we've been, supposed to think of real estate as this great hedge. And it is until you hit a hyperinflationary stage. Then all of the garbage that's been built up underneath it, all of this stuff, it's the only tool they have left, the only one. And I was listening to President Trump at Davos, and he was talking about that we are going to grow our way out of this problem, and we're going to lower rates, right? And what that really means is we need more inflation. We need more of this stuff. Do we need more of that stuff? Yeah, we do, because we are now in this doom loop that we cannot escape from. This is the end of this currency's life cycle. This big fiat money based on debt. And in order to start into a new system, which is a full surveillance system, as you well know, they have to get rid of the debt. Because I questioned for a long time, what is going to justify creating new money in this system? And all of my reading were about two things, either debt or purchases. And now when President Trump, I think we talked about this before too, but when he signed the Genius Act legalizing stablecoins, my questions were answered because it's going to be a combination of purchases along with debt.
Spot gold prices are arguably approaching $5,000, a figure that reflects not an increase in the metal's intrinsic worth, but a catastrophic collapse in the dollar's purchasing power. Comparing modern valuations to the historical $20 face value of gold coins reveals the extent of this devaluation. The financial system itself acknowledges this reality, with at least 33 major entities and central banks aggressively accumulating bullion since 2005. This pivot marks the actual death of the debt-based model, which technically failed in 2008, forcing authorities to change the trajectory of their reserves in anticipation of a reset. The current economic trajectory is described as a terminal doom loop, in which the only political solution is to inflate away the debt through lower rates and currency debasement. While real estate is traditionally viewed as a hedge, it is increasingly vulnerable to policies such as rent caps, leaving precious metals as the only asset class immune to counterparty risk. The analysis points to the legalization of stablecoins via the Genius Act as the final bridge to a surveillance-based monetary system, where money creation is driven by direct purchases and debt monetization, marking the absolute end of the current currency lifecycle. Share your thoughts on her analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.